In the world of high-stakes speculation, there are two distinct types of operators. There are those who seek to achieve greatness through a brilliant offense, placing massive, aggressive bets in the hope of capturing spectacular returns. And then there are those who achieve greatness through a relentless, suffocating defense. They are the masters of survival, the strategists who understand that the key to winning is not dying. No one in modern financial history embodies this defensive philosophy more completely than Paul Tudor Jones. While his legendary market calls have earned him a place in the pantheon of the world's greatest traders, his true genius lies not in his predictions, but in his process. It is a methodology built on a foundation of historical analysis, technical precision, and above all, an obsessive, all-consuming focus on risk management. His entire career is a testament to his most famous principle. The most important rule of trading is to play great defense, not great offense. This statement is not a catchy slogan. It is the central axiom of a comprehensive doctrine forged in the trial by fire of the commodity pits and refined over decades of navigating the market's most treacherous currents. This is the story of how that defensive doctrine was built, and how it allowed him to find repeating cycles of fear and greed in the chaos of the markets. To understand his legendary trades, one must first deconstruct the intellectual framework that made them possible. We will explore the origins of his defensive mindset by examining his trial by fire in the commodity pits, his unique interpretation of technical analysis, and his master tool for identifying major market turns, the historical analog. To understand the operator, one must first understand his training ground. Paul Tudor Jones was not the product of an Ivy League economics program or a Wall Street investment bank. His education came from the most visceral, primal, and unforgiving classroom in all of finance, the open outcry commodity pits. After graduating with an economics degree from the University of Virginia in 1976, he sought out a position in this world, eventually landing a job as a clerk on the floor of the New York Cotton Exchange. This was not a world of abstract theories or elegant mathematical models. It was a physical, chaotic, and often brutal environment where fortunes were made and lost in a matter of seconds based on the raw, unfiltered flow of buy and sell orders. It was a world of hand signals, of shouting, of feeling the literal press of the crowd as waves of greed and fear washed over the pit. Standing in the pit, day after day, Jones learned to read the market not as a series of numbers on a screen, but as a living, breathing organism. This experience was the bedrock of his entire career, instilling in him skills that could never be learned from a book. He developed an intuitive, almost sixth sense for order flow. He could feel the subtle shifts in momentum, sensing when a large commercial buyer was patiently accumulating a position on the dips, or when a panicked seller was about to dump their entire position and collapse the price. He learned to distinguish the aggressive, confident buying of informed operators from the frantic, fearful buying of amateurs at the top of a move. He learned that the price on the tape was only a small part of the story. The real information was in the volume, the pace, and the character of the trading. This visceral education taught him that the market, at its core, is a reflection of human emotion. It is a constant battle between fear and greed, played out in a grand auction. The patterns he would later analyze on charts were not abstract shapes to him. They were the graphical footprints of the human dramas he had witnessed firsthand. This formative experience explains why, throughout his career, he has always remained a master of the tape, a trader who trusts the market's own action above all else. His famous rule, "Don't ever average losers," was not an academic theory. It was a survival law learned in the high-leverage world of futures trading, where a single undisciplined trade could mean total ruin. During this period, he was taken under the wing of a legendary cotton trader named Eli Tullis, a relationship that would profoundly shape his philosophy. Tullis was a master of risk management and a fierce contrarian. He taught Jones the hard-won lessons of the pit. How to take a small loss without hesitation, how to think relentlessly in terms of risk versus reward, and the supreme importance of discipline. Tullis was known for his toughness and his intolerance for foolish mistakes. He ingrained in Jones the idea that a trader's primary job is to survive. Profitability is a byproduct of survival. This mentorship was Jones's PhD in market psychology. It was from Tullis that he learned to separate his ego from his trades and to view losses not as personal failures, but as expected business expenses. This defensive capital preservation first mindset, learned at the feet of a master, would become the defining characteristic of his entire career. After a few years of trading his own account with remarkable success, Jones was ready to transition from the floor to running his own fund. In 1980, at the age of 26, he founded Tudor Investment Corporation. It was here that he began to synthesize his intuitive feel for the market with a more rigorous, analytical framework. As he moved from the pit to the office, Paul Tudor Jones needed a way to translate his visceral understanding of market action into a systematic, analytical process. He found his language in the field of technical analysis. For him, the price chart was the perfect tool. It was a newspaper that told the story of the ongoing battle between buyers and sellers, a graphical representation of the collective psychological state of all market participants. His approach to technical analysis is not about finding magical, predictive patterns. It is about identifying the market structure, gauging its psychological state, and finding low-risk points to enter a trade. It is a framework built on a few simple but powerful concepts. His primary technical tool, the one he has cited as the most important metric he looks at, is the 200-day moving average of closing prices. He uses this simple, long-term average as his primary determinant of the market's major underlying trend. His rule is deceptively simple but incredibly powerful. If the price is above the 200-day moving average, he is operating with a bullish bias and is only looking for opportunities to buy. If the price is below it, he is operating with a bearish bias and is only looking for opportunities to sell. This simple filter acts as a powerful disciplinary mechanism. It keeps him on the right side of the market's major tides and prevents him from committing the cardinal sin of fighting the dominant, long-term trend, a mistake he sees as the primary cause of ruin for most traders. He famously stated, "My metric for everything I look at is the 200-day moving average of closing prices. I've seen too many stocks go to zero and stock markets crash 80%. I want to be on the right side of the 200-day moving average." This is not a simple entry and exit system. It is a regime filter. It tells him which playbook to use. Above the line, the playbook is bullish. Buy dips, look for long setups, and treat bearish news with skepticism. Below the line, the playbook is bearish. Sell rallies, look for short setups, and treat bullish news with extreme caution. Within this broader trend framework, Jones is a master of analyzing ranges and volatility. He believes that volatility is cyclical. Markets move from periods of low volatility, or range contraction, to periods of high volatility, or range expansion. A consolidation or a trading range is a period of low volatility where market energy is being compressed and stored like a coiling spring. This is a period of indecision and equilibrium. A trend or a breakout from that range is the release of that stored energy. His strategy is to identify these periods of coiling energy and to enter a trade at the very beginning of the range expansion, the moment the spring uncoils. This is the point of maximum potential energy with the most clearly defined risk, the other side of the consolidation range. He is, in essence, a breakout trader, but one who waits for the quietest, most compressed conditions to place his bets, ensuring that he is entering just as the new, powerful move is getting underway. To further refine his understanding of the market's position within a larger cycle, Jones was a known student of more complex technical theories, most notably Elliott wave theory. He did not use it as a rigid predictive tool for pinpointing exact price targets, but rather as a roadmap to help him understand the sentiment and maturity of a trend. The Elliott wave principle posits that market movements unfold in a repeating 5 to 3 pattern, 5 waves in the direction of the primary trend, followed by 3 corrective waves. For Jones, this framework was invaluable for contextualizing price action. The 5-wave advance, for example, has a distinct psychological profile. Wave 1 is the initial move off the lows, often unnoticed by the majority. Wave 2 is a deep, discouraging pullback that fills participants with doubt. Wave 3 is the powerful, obvious heart of the move, where conviction is highest and participation is broadest. Wave 4 is a complex, choppy, and frustrating correction, and Wave 5 is the final, often euphoric push to a new high, a move that is frequently accompanied by weakening momentum and bearish divergences. By having this psychological roadmap, Jones could adjust his aggression and risk exposure. He would be most aggressive and confident during a 3rd wave, but would become extremely cautious and defensive during a 5th wave, knowing that it was likely the final stage of the advance before a major correction. While his foundation was in classic technical analysis, the element that elevated Paul Tudor Jones from a successful trader to a living legend was his secret weapon: the obsessive and systematic use of historical analogues. Jones operates from a core belief that while the instruments, the regulations, and the players in the market change, the driving forces of fear and greed are timeless constants of human nature. Therefore, the market patterns that are a reflection of that immutable human nature must also repeat, or at least rhyme, across different eras and different markets. His process involved a deep, almost fanatical study of financial history, searching for periods in the past that closely mirrored the current market environment. He was not looking for a vague resemblance. He was looking for a precise, quantifiable correlation in price, volatility, and sentiment. His research team would create transparent chart overlays, literally placing the price action of the S&P 500 from the 1980s on top of the price action of the Dow Jones Industrial Average from the 1920s. He would analyze not just the price, but also the accompanying sentiment, monetary policy, and speculative fervor of each era. He believed that if he could find a historical market that was tracking the current market with a high degree of correlation, that historical chart could serve as a highly probable roadmap for the future. His most famous application of this method, which we will deconstruct in detail in Part 2, was his analysis of the 1980s bull market. As the market roared higher in 1986 and 1987, Jones became increasingly convinced that he was witnessing a speculative mania that closely resembled the roaring 20s bull market, which had preceded the great crash of 1929. The overlay of the two charts showed an eerily precise correlation. This historical analog gave him the profound conviction that the 1980s bull market was destined to end in a similar catastrophic collapse. This unique methodology of using the past as a direct, predictive, analytical tool is what sets him apart. It is a strategy built on the belief that history, driven by immutable human psychology, does not just repeat. It provides a tradable, high-probability pattern. This brings us to a critical debate about this very method. Is the use of historical analogues a valid predictive tool that reveals repeating cycles of human behavior? Or is it a sophisticated form of confirmation bias, where an analyst can always find some past pattern to fit their current view, while conveniently ignoring the countless times the analogues failed? We want to hear from you. Before we continue in Part 2 with the legendary trade that was born from this analysis, tell us in the comments, do you believe historical chart analogues are a legitimate strategic tool or a dangerous analytical trap? The psychological conviction required to act on such a contrarian analysis is immense. To stand against a roaring bull market requires a deep understanding of the mass psychology that fuels such trends. The timeless dynamics of greed and fear that create these repeating market cycles are a subject of intense study for any serious operator. For any student of this psychological dimension of the markets, the foundational text remains Edwin Lefebvre's classic Reminiscences of a Stock Operator, based on the life and trades of Jesse Livermore. To make its century-old wisdom immediately actionable for today's market participants, we have linked in the description an essential modern resource. The 2025 Annotated edition, a version featuring an in-depth, chapter-by-chapter analysis for the modern speculator by Max Davidson. Mastering this psychological component of market dynamics is a critical element of long-term survival, a principle that universally separates professional operators from the amateur crowd. This understanding was a key pillar upon which Paul Tudor Jones built his entire defensive system, a system designed not just to profit from cycles, but more importantly, to survive them. The analytical framework developed by Paul Tudor Jones, a unique synthesis of a pit trader's intuition, a chartist's precision, and a historian's perspective, provided him with a powerful lens for viewing the markets. It allowed him to identify the psychological state of the market, understand its position within a larger historical cycle, and formulate high-probability hypotheses about its future direction. But this framework, as brilliant as it was, represented only one half of the equation for long-term success. A brilliant market thesis in the world of high-stakes speculation is not just worthless without a corresponding doctrine of execution and survival. It is actively dangerous. It can lead to a sense of overconfidence that encourages reckless risk-taking and ultimately ruin. The true source of Jones's longevity and consistent profitability is not found solely in his market calls, but in the operational system that governs his every action. This is his Doctrine of Defense, a comprehensive, interlocking set of rules and psychological principles designed not to maximize profits on any single trade, but to ensure survival and optimize performance over a lifetime of trading. To understand this doctrine is to understand the very engine of his compounding machine, and to see how his analytical insights were translated into one of the greatest trades in financial history. The absolute cornerstone of his risk management, the single rule that filters every decision he makes, is the 5-to-1 doctrine. This is not merely a guideline. It is the fundamental law of his trading universe. The principle is as simple in its statement as it is profound in its implications. He will not enter a trade unless he sees a realistic potential to make $5 for every $1 he is risking. This rule is the ultimate expression of his defensive philosophy, as it forces him to think about the downside of a trade before he even considers the upside. The execution of this doctrine is a systematic, two-part process. The first and most critical step is to define the one, his unit of risk. Before entering any position, Jones first identifies a precise logical point on the chart where his initial thesis would be proven wrong. This could be a recent swing high or low, a key support or resistance level, or a major moving average. He then places his stop loss just beyond that point. The distance between his entry price and his stop loss is his quantifiable absolute risk on the trade, his 1R. Only after his risk is clearly defined and accepted does he consider the potential reward. He uses his analytical tools, chart patterns, Elliott wave projections, or historical analogues, to project a reasonable price target for the move if his thesis proves correct. This target must be at least 5 times greater than the size of his initial risk. If he is risking 2 points on a trade, his minimum potential target must be 10 points away. If this 5-to-1 asymmetry is not present, he passes on the trade. It does not matter how compelling the narrative is, how strong his conviction is, or how much he likes the idea. If the risk-reward profile does not meet his strict mathematical criteria, he does nothing. This filter is what keeps him out of low-probability, mediocre trades that chew up the capital and mental energy of average traders. It forces him to wait patiently, sometimes for months, for the rare, high-conviction opportunities where the odds are overwhelmingly skewed in his favor. It is a discipline of extreme selectivity. The strategic implication of the 5-to-1 rule is immense, as it inherently forces him to be a contrarian. One does not find these types of asymmetric opportunities in the middle of a comfortable, widely recognized trend. By the time a trend is obvious to everyone, the risk and reward are typically more balanced, as the easy money has already been made. True 5-to-1 bets are almost exclusively found at major market turning points, at the emotional extremes of fear and greed. They are found at the peak of a speculative mania, where one can initiate a short position with a tight, logical stop-loss just above the highs, while the potential downside is a collapse of the entire structure. They are found at the bottom of a panic-driven crash, where one can buy into the capitulation with a clear stop just below the lows, while the potential upside is a powerful rebound rally. The 5-to-1 doctrine is a mechanism for finding points where the market consensus is not just wrong, but emotionally and dangerously so. It is a systematic hunt for what Jones calls the screaming buy or the screaming sell, the points of maximum opportunity where, in his words, the market is at a point where it is so overbought or oversold that it is going to have a violent reaction in the opposite direction. This grand strategic filter is supported by a set of rigid mechanical rules for capital preservation. The first is his strict 1 to 2% capital risk rule. No single trade, regardless of his level of conviction, is ever allowed to risk more than a small fraction of his fund's total capital. This ensures that no single bad decision can ever be fatal. He understands that losses are an inevitable and frequent part of the trading process. Even with his 5-to-1 filter, he knows that he will be wrong many times. By keeping each individual loss mathematically insignificant, he guarantees that he can withstand the inevitable strings of losing trades that every trader must endure. For a hypothetical $100 million fund, a 1% risk means no single trade can have a predefined loss greater than $1 million. A string of 5 consecutive losses would result in a manageable 5% drawdown. For an amateur trading without this rule, a string of 5 losses could easily wipe out 50% or more of their capital, a psychologically and financially devastating event. This rule is the mathematical foundation of his survival. It ensures that he will always have the capital and the psychological fortitude to be in the market and ready to act when the next 5-to-1 opportunity presents itself. This is further reinforced by his absolute prohibition against averaging down on a losing position. He famously stated, "Don't ever average losers." For Jones, a trade that is moving against you is not an opportunity to buy more at a cheaper price. It is the market providing you with a clear, unambiguous signal that your initial hypothesis was wrong. To add to a losing position is an act of ego, a refusal to accept the market's verdict. It is a doubling down on a mistake, a behavior driven by the hope of getting back to even. Jones's approach is the polar opposite. The moment a trade moves against him and approaches his predefined mental stop, his only thought is to exit. He liquidates the position, accepts the small loss as a business expense, and moves on, his mind clear and his capital preserved. This discipline of treating a loss as new information, rather than a personal failure, is a key separator between the professional and the amateur. His entire defensive mindset can be summed up in his own words. "I'm always thinking about losing money as opposed to making money." At the end of the day, the most important thing is how good are you at risk control. This productive paranoia, this constant stress testing of his own positions, is what prevents the complacency that is the #1 killer of great traders. The culmination of this analytical framework and defensive doctrine was the single greatest trade of his career, a trade that became the stuff of legend and served as the ultimate vindication of his entire methodology, his massive short position during the stock market crash of 1987. This was not a lucky guess. It was the result of a years-long analytical process, a meticulously planned campaign, and the flawless execution of his risk management principles. The story of the trade begins with his secret weapon, the historical analog. Throughout 1986 and into 1987, Jones and his small team of researchers became increasingly convinced that the powerful bull market of the 1980s was tracking the roaring 20s bull market with an eerie and unsettling precision. They created chart overlays that mapped the price action of the S&P 500 in their current era onto the price action of the Dow Jones Industrial Average from the 1920s. The correlation was undeniable. They saw the same parabolic, accelerating advance, the same blow-off in speculative sentiment, and a similar pattern of rising interest rates from the central bank. This historical map gave him a powerful conviction. If the pattern continued to hold, the 1980s bull market was destined to end, not in a gentle correction, but in a violent, catastrophic collapse, just as it had in 1929. This thesis became the central focus of his fund. As 1987 progressed, the real-time evidence began to confirm his bearish thesis. He saw numerous warning signs that the market was becoming dangerously unstable. Bullish sentiment had reached a state of euphoria. Valuations were stretched to historical extremes. And most importantly, the Federal Reserve, concerned about inflation, was actively tightening monetary policy, raising interest rates and removing liquidity from the system. He saw all the classic preconditions for a major market top. Armed with his historical analog and the confirming evidence from the current market, he began to build his position. He started to methodically short S&P 500 futures contracts, the most direct and liquid way to bet against the overall market. He started relatively small, testing his thesis. As the market began to show signs of weakness in August and September, confirming his analysis, he became more and more aggressive, adding to his short position on any rallies. He was applying his 5-to-1 doctrine. His risk was a potential breakout to new highs, a move that seemed increasingly unlikely, while his potential reward was a market collapse of 20, 30, or even 40%. The asymmetry was profound. The climax came on the morning of Monday, October 19, 1987, a day that would be forever known as Black Monday. The panic had already begun overseas, with massive sell-offs in the Asian and European markets. When the New York Stock Exchange opened, the selling was immediate and overwhelming. The relatively new trading strategy of portfolio insurance, a computer-driven program designed to sell futures to hedge a declining stock portfolio, created a toxic feedback loop. As prices fell, the computers automatically sold more futures, which drove prices even lower, triggering more automated selling. It was a reflexive process of unprecedented speed and violence. While the rest of Wall Street was paralyzed in a state of shock and terror, Paul Tudor Jones was in his element. This was the moment his entire career had prepared him for. His analysis had predicted it, his defensive positioning had prepared him for it, and his rules of execution dictated his actions. He did not just passively hold his winning short position. According to accounts from that day, he actively traded around it, adding to his position on the weak intraday bounces, demonstrating his absolute conviction that the market was in a state of freefall. He was not just short, he was doubling down on the crash. By the end of the day, the Dow Jones Industrial Average had collapsed by 508 points, a staggering 22.6% decline that remains the largest single-day percentage drop in the index's history. While fortunes were wiped out and entire firms were driven to the brink of insolvency, the Tudor Investment Corporation had one of its best days ever. It is estimated that his fund returned a remarkable 62% in the month of October alone, with Jones personally earning an estimated $100 million from the crash. This trade was the ultimate vindication of his entire methodology. His use of historical analogues gave him the contrarian thesis. His technical analysis allowed him to time his entries and confirm the market's weakening structure. And his deeply ingrained principles of risk management gave him the psychological fortitude to build a massive position and hold it through to its spectacular conclusion. While the 1987 crash was his most famous trade, it is a critical mistake to view Paul Tudor Jones as a one-dimensional perma-bear. His success over 4 decades is a testament to his flexibility. He's a pure opportunist, equally capable of being aggressively bullish when his analysis warrants it. His strategy is not about being bearish or bullish. It is about identifying conditions of extreme asymmetry, where the risk-reward is heavily skewed in his favor, regardless of the direction. For instance, he successfully navigated and profited from the powerful bull market of the 1990s, recognizing that the macroeconomic environment of falling inflation and technological innovation was a powerful tailwind for stocks. His method is not dogmatic. It is adaptive. He is constantly re-evaluating his positions and is famous for his willingness to change his mind in an instant when the evidence on the tape changes. His loyalty is not to a preconceived opinion, but to the reality of the market's price action. The first step in building a successful system is building the habit of disciplined study. The philosophy of Paul Tudor Jones is not an abstract theory. It is a set of principles that requires reinforcement. If you are serious about developing the habits necessary for success, subscribe to this channel and click the notification bell. Let this be the place you come to forge the intellectual framework that will define your future in the markets. In conclusion, the enduring legacy of Paul Tudor Jones is that he represents a unique fusion of skills. He possesses the intuitive, visceral feel of a pit trader, the structured pattern recognition skills of a technical analyst, the deep contextual understanding of a market historian, and the iron-willed discipline of a professional risk manager. He has demonstrated that the path to long-term success in the markets is not paved with brilliant offensive predictions, but with a relentless, paranoid, and all-encompassing defense of one's capital. His career is the ultimate proof that in the world of speculation, survival is the only road to victory. His final lesson is the one he stated at the very beginning, a principle that should be etched into the mind of every aspiring trader. The most important rule is to play great defense, not great offense.